etc. The personal exemption deduction. This was a per person deduction that you, if you recall, on your 2017 return, it was a little over $4,000 per person that was granted as the deduction on the return. This deduction is going to be suspended until 2025. So the loss of that deduction becomes more consequential for, say, married couples with many dependents. The more dependents you have, the more consequential that loss is going to become. But that loss is reasonably offset by the decrease in the tax rates and the increase in the child tax credit. So I have a note there that child tax credit, which is for children under 17 years old, was increased from $1,000 per child to $2,000 per child. In addition, they added a $500 tax credit for any other dependents you might have that don't necessarily meet this child tax credit. In other words, they're not your child, they're not under 17, but if they are still your dependent, there's this new $500 tax credit. Now, there is a phase-out range for these things when your adjusted gross income exceeds $400,000 for married couples, $200,000 for all others. Probably not, again, not going to affect too many of you, but just to mention that it's there. Now, the nice part about these child tax credits is that there is a refundable portion. In other words, if the credit exceeds your tax liability, up to $1,400 per child is refundable. You can actually get it refunded to you. The $500 credit they added, unfortunately, is not refundable. Just to add in here, just regard to capital gains rates, I'm not sure how many this might apply to, but the rates themselves are going to stay the same, with the highest income taxpayers paying, again, 20%. And then there's also an additional net investment income tax of 3.8% on top of that. But the break points where the capital gain rate, it initially starts at 0 and then moves to 15% before it reaches that 20%. Those break points where we get from the 0 to the 15 to the 20, you see it laid out there for married taxpayers. The break points for single and or head of household are slightly lower than these numbers. But the key point here is these break points are significantly higher than they used to be. So for most taxpayers, if you have capital gains or qualified dividends are dividends received on stocks that you've held for more than a year. If you have either of these income sources, your capital gain tax rate here most likely is going to be 15% and possibly 0, again, depending on your income. So that was a pretty significant change for those with that type of income. Now, in the law, they made several changes to itemized deductions. So some of the more relevant changes are these. So first of all, with the medical deduction. For 2018, the threshold for medical deduction is going to be 7.5% of your adjusted gross income, but it will return to 10% in 2019. What this means is that you can deduct on your tax return, if you're itemizing, you can deduct the total amount of unreimbursed medical costs that exceeds 7.5% of your adjusted gross income. And then again, in 19, that's going to increase to 10%. With that threshold increase going to go in place next year, if you believe you may be itemizing your medical expenses for 2018, you may want to consider accelerating certain medical expenses this year, thereby increasing your medical write-off for this year, knowing that next year the threshold's higher, you might not get the benefit of those same expenses. So that's something you may want to consider. The home mortgage interest deduction was modified by simply putting a cap on the amount of debt that can be considered for that interest deduction. Now that cap is reduced to $750,000. The prior limit was $1 million. Again, this probably is only relevant to those who might be living in a high cost region like the Northeast here, or on the West Coast or some other metropolitan areas. The home equity loan interest, however, is now only deductible if you use the proceeds to buy, build, or substantially improve your primary residence. There was some confusion about this when the law was first passed, but the IRS has recently clarified this in other regulations. So basically what it means is if you used home equity debt for, say, a new car or school tuition or other personal expenses, the interest on that debt portion is not deductible. So this does present some record-keeping issues if you did use home equity loans or credit lines in multiple ways. And there will need to be some tracing that has to take place as far as what portion of the loan you used for what purpose, how we allocate the interest to each debt portion, and how the repayment of those funds are allocated to each portion of the debt. There are some rules already in place previously. I would imagine the IRS is going to clarify that some more, but just keep that in mind if you do have home equity debt with some mixed use in there. With regard to state and local taxes, this includes state income taxes or local income taxes, real estate taxes, or other property taxes that you might pay. The total of that deduction is now going to be capped at $10,000. It's split to $5,000 if you happen to be married filing separately, but $10,000 is that cap. We'll discuss this a little more shortly on a later slide and get into a little more of that detail on that. Also, keep in mind that miscellaneous itemized deductions, which are subject to a 2% cap of AGI threshold, they are no longer deductible at all. So this too I'm going to discuss a little bit on a different slide. So just kind of keep that in the back of your mind. One of the things that we have is because of the increase of the standard deduction and the cap on the state and local tax deduction that we'll talk a little bit more about, most taxpayers are now going to opt to use the standard deduction instead of itemizing. Now, because of that, one of the possible planning opportunities under the new law would be to consider if bunching certain transactions or certain deductions in alternate years would enable you or could enable you to benefit by itemizing perhaps 1 year, then taking the standard deduction the next. So I made this little example just to give you a visual of how this might work. So perhaps in a regular year, your itemized deductions might total, in this case, $23,500 for a married couple. That's just below the standard deduction. But by adding some additional or prepaying some of these other deductions in that same year, you can increase your itemized deductions to a number higher than the standard deduction. And so therefore you would get the benefit of those deductions by bunching them into 1 year. Then in the alternate years, where your itemized deductions now will drop because you've prepaid some of it, you just fall back on the standard deduction. So this can be a good strategy. It can work if your itemized deductions normally are somewhere near that standard deduction threshold, and where you, by bunching, you can kind of go over 1 year, under the next, over 1 year, under the next, and so on, and kind of maximize the tax benefits there. In terms of the state and local tax deduction, so again, I mentioned that there's a $10,000 cap on these deductions. This limit will expire after 2025, but obviously for the next few years we're going to be dealing with this. There was a lot of to do about this, particularly in our area, with many of our residents in New Jersey rushing out to prepay property taxes in 17. Believing they weren't going to get the full deduction in 18. And as such, there were special rules that were put in place to prevent the deduction, for example, of 2018 income taxes paid to the state if you prepaid them in 17. There's some special rules with that. And the IRS also issued guidance related to the prepayment of 2018 real estate taxes in 17, stating that they needed to have been assessed and paid in 17 in order to be deductible. So if you were one of those people that did go out in 17 and prepay your 18 taxes to try to get the deduction in 17. Please keep that in mind when you do your 18 return, that you don't take those same taxes as a deduction again. Some of this restriction on state and local taxes may be more relevant again for taxpayers living in areas like the Northeast, the West Coast, a few other metropolitan areas where property taxes and state income taxes could be a bit higher. But if you should live in an area that does have more favorable state or local taxes, or perhaps no state income tax, this state tax deduction, again, is another one of those areas where perhaps by bunching some of your local property taxes, you could save some taxes in alternate years. Regarding charitable contributions, there's been a few changes here. The cash contribution limit has been increased from 50% to 60% of your adjusted gross income. So what that means is you can deduct charitable donations made up to 60% of your adjusted gross income. This also is a temporary increase and is slated to expire in 2025. And should you have any excess donations, they can be carried forward and deducted for up to 5 years. Now, again, this may not affect you individually, but this may be important to know for perhaps members of your congregation who might be in a position to utilize this. Another change is the exception to contemporaneous written acknowledgement requirement. That was repealed. So what that means is that for any donation of $250 or more, a written acknowledgement must be obtained. So basically, there are no exceptions. Any donation of $250 or more must be, they must receive an acknowledgement. And this was effective in 17, but certainly it's effective for 18. And I mention this so that churches can be sensitive to this requirement and to always provide acknowledgments on a timely basis to their members and other donors to the church. That acknowledgement can be provided on a periodic basis if you so choose, either on a monthly, quarterly, or annual basis, and can be provided as a total contributed for that particular period, though some churches will itemize a list as well. That is also acceptable. On a side note, with regard to charitable donations, there's been a lot of discussion as to the possible effects of the tax reform on charitable giving. As I mentioned, the rise in the standard deduction, most taxpayers may receive a greater benefit from the standard deduction rather than itemize. So perhaps the tax incentive of charitable giving may be diminished. It's my personal opinion that faith-based organizations should not really see any significant reduction from this. And others have argued that with the overall tax savings that most will see under the tax reform, there would be more disposable income, which perhaps would keep that charitable giving at the same level. We'll have to see how this does in fact play out over the next few years, but just again, so you are thinking along those lines as well. With regard to charitable contributions, though, there are some strategies that taxpayers can use to try and maximize their tax savings. The first one is by using what's known as the IRA qualified charitable donation. Under this provision, the owner of an IRA can direct the IRA to make a distribution payable to the charity of the owner's choice, but it is limited to $100,000 per year. That distribution, if it's done in that way, is not recognized as taxable income. So the owner effectively gets a deduction even if they do not itemize. So this perhaps could be a useful tool for some members of your congregation, particularly retired members who may or may not necessarily be able to itemize. If they use this feature to, say, contribute to your church, they would get effectively the deduction for that donation. Another strategy that can be used very effectively now is the use of donor-advised funds. In this situation, the donor contributes whatever dollar amount they choose to the fund, and they're entitled to a charitable deduction that year on that amount that they contributed. However, the money goes into a fund and they can now direct the fund to distribute the funds to the charity of their choice at any time they choose, which could be a subsequent year. So this could be a useful strategy, again, maybe perhaps part of a bunching strategy with the deductions to maximize the tax savings. There's also charitable trusts, which can be used, but in this case of a charitable trust, the charity does not receive the money typically until the grantor passes away. There are additional rules with each of these options, but they can be used very effectively. So again, perhaps this is something some of your congregants might be interested in as well. Regarding the miscellaneous itemized deductions, again, these deductions are being eliminated effective this year. Some of the examples of what is included in this category would be unreimbursed employee expenses, tax preparation fees, investment fees or expenses, legal fees, and safe deposit box fees. Now, there are some other miscellaneous deductions that are not subject to this 2% limit, and they are still in effect. That includes a casualty loss. We're going to discuss casualty losses a little bit later. But keep this in mind that these deductions are going away. And one of the ones to focus on here as far as clergy and churches is the elimination of this deductibility on the unreimbursed employee expenses. Because of that, it's probably more important than ever for churches to use accountable reimbursement plans to reimburse their pastors for any out-of-pocket expenses related to the ministry. Now, many probably already have some of these arrangements for things like the pastor's travel, continuing education, and so on. But if not, this should be a discussion for your next budget meeting to institute something like that. And at the very least, what you can do, if you're not setting aside money in your budget specifically to reimburse a pastor, at the very least, you could discuss reallocating his overall compensation package and by doing so, turning some taxable wages into non-taxable reimbursements. So this is one area that churches should really be looking at. With regard to the Affordable Care Act, perhaps many of you have heard that under the Tax Reform Act, the individual mandate has been repealed, but that repeal does not start until 2019. So it's still in effect for 2018. And the IRS has made it pretty clear that for the upcoming filing season, they're not going to accept returns if the return does not address the health coverage requirements. So there's different schedules or check boxes that you have to still check off for 2018. The penalty for non-coverage remains at the higher of 2.5% of yearly household income, or $675 per person, with a lower amount for children under 18. The exception, many of you perhaps are using a healthcare ministry sharing program like MediShare or Samaritan Ministries and the like. The exemption for those still applies. So again, you have to fill out that schedule on the return and indicate your coverage is with a ministry sharing program. The rules for employer-sponsored health reimbursement arrangements, those are still in effect. Those plans can be used to assist pastors in paying their medical expenses, including healthcare premiums. Those are still in effect, with the annual caps remaining at $5,050 for single employee or $10,250 for an employee with family. So keep that in mind as well. They did not change those rules at the present. Briefly, just regarding the alternative minimum tax, the AMT continues to exist. However, they made several changes in it to increase the exemption amounts, increase the thresholds for the phase out on some of those things. So it's still there, but the fact is that due to the increase in the exemptions on the AMT and due to the phase out limits being increased, due to the elimination of several key triggers of the tax, including state and local income taxes and the miscellaneous itemized deductions, it's more likely that most taxpayers now will not be subject to AMT anymore. Probably this is good news for some of you if you're living in the Northeast, the West Coast, and other metropolitan areas where you may have been affected. But it's with these changes, it's probably going to affect fewer and fewer taxpayers now. Just a note on a few other individual changes. I talked about or mentioned casualty losses earlier. So casualty losses are still deductible. However, it's limited now only to losses attributable to federally declared disaster areas. So again, if you just have a house fire or things like that, no longer a deductible loss. But again, for say folks in the hurricane affected areas this year, they will still be able to deduct those losses. Another note, alimony. They're changing the rules with regard to alimony effective for any divorces executed after the end of this year, where it will no longer be deductible by the payer or taxable to the recipient. I'm only mentioning this as it may be relevant for you to know if you or your diaconate get involved in any kind of current counseling situations with these. So just keep that in mind. Another more relevant change for churches and pastors is that the moving expense deduction has been repealed. And the corollary to that is that any moving expense reimbursements are all fully taxable now. So what this means is that if you should happen to move, change congregations, and receive a reimbursement, that's going to be fully taxable, and that needs to be factored in when you're estimating your taxes for that particular year. So that also is another one that's going to impact most churches, from periodically. Another change to note that may impact some of you is a change in what's called the kiddie tax. This is the tax on the unearned income, so interest, dividends, and so on, for any dependent children that you have under the age of 17 or under the age of 24 if they're still a full-time college student. What they've done here is they've now tied those tax rates on that income to the rates for trusts and estates, which are not very favorable rates, as you can see there. So in many cases, you could be in a situation, if you have this, where the tax on the child's unearned income could be at a rate higher than the parent's rate, and that's not ideal. So if you have a situation where you have money invested in your child's name, what you may want to do is try to focus on investments that achieve capital gains or qualified dividends, in other words, dividends on stocks held for more than a year, because that at least will keep it down to the capital gain rate, which is lower than these rates that you see. Also, it just kind of reemphasizes the importance of, instead of putting money simply in the child's name, perhaps putting that money into a 529 plan to save for college, if that is the original intent of that money, to save it for college. Because with the 529 plan, the earnings are tax-free when used for college expenses. So just keep that in mind. There's some other changes with the 529s. I'm going to talk about that shortly. Here's a few changes with retirement plans, as well as just trying to give you a reminder of what the 2018 plan contribution threshold limits are. For 2018 and beyond, the ability to recharacterize a Roth conversion to a traditional IRA has been removed. Some of you may have traditional IRAs that you may want to convert to a Roth. It used to be if you did that, wanted to change your mind and change it back, you could do that. Now they're saying once you go from traditional to Roth, you cannot go back. So just something important to keep in mind. And then again, here are the threshold limits for plan contributions for this year. So you may want to look at that and see if it's possible to try to increase your deferral to take the maximum benefit. Here's a quick slide regarding the estate and gift tax changes. Obviously, the estate tax exemption amount is way up to $11.2 million. And the annual gift tax exclusion amount, in other words, how much you can gift to another individual in a particular year, is up to $15,000 now. Now, the estate tax exemption being as high as it is may pretty much eliminate the estate tax for most individuals on a federal level. But that doesn't mean you don't need to do estate planning. So keep that in mind, because for one, some states have different thresholds. And so you still need to address that. But also, as we've listed here, there are other reasons to review your estate plan and to have an estate plan. So you need to keep that in mind as well. When it comes to education tax benefits, one of the big changes is if you do have a Section 529 plan for college savings, the new law permits you to use those funds to pay for private school tuition. So that could be elementary, secondary, or high school. So that is an option that some may find beneficial, and that is now permitted. And what they also said is that if you have 529 plan assets that are more than you need, or they're left over from paying for a child, if you have an ABLE account for a different family member, you can transfer the funds to that with no tax consequence. Now, ABLE accounts are tax advantage savings accounts designed for dependents with disabilities. So if you have a situation like that, keep in mind these transfers can be made. Also, the last thing they changed is student loan forgiveness will not be taxable income upon the student's death or total disability. So that's another key change there. This is just a refresher on what education tax credits are still available. You'll see them listed there. Keep in mind that these credits must be calculated in coordination with other education advantage provisions like tax-free 529 distributions or Series E and I bonds that you cash in and want the interest exclusion on that because you're using it for education. All these things have to be coordinated when you do your tax return. So there are some changes in the withholding tables for 2018, and it's important to make sure you review your 2018 tax situation, determine if you need to make any adjustments there based on what changes you anticipate having, some of the changes we've just discussed. Some of you may be paying quarterly estimates. There too, you need to just kind of review your 2018 tax projections, factoring in some of these changes to make sure that you will be on target with your taxes. Part of the tax projection can also factor in these available tax credits that we're talking about, the per child tax credits, the education tax credits, and so on. In some cases, you may have excess credits, as it were. You know, some of them are refundable, some of them are not. So there may be situations where if you have these credits and they're by and large much larger than your actual tax liability, you may want to take advantage of that by doing something like, say, a Roth IRA conversion in that year. To use, that creates a taxable event, but if you have the credits that can offset that tax, that may be a good strategy to do. Or you could choose to redesignate any remaining 401k or 403b deferrals and redesignate them as Roth deferrals. Then thereby, again, though it creates more taxable income, you have those credits to help offset. So that's just something you may want to review. I was asked to take a little bit of time to review the proper reporting for congregations of pastors' compensation. There is much confusion on the issue, and there's many varied practices out there. What I'm going to discuss here is the method laid out by the IRS in publication 517. That publication I highly recommend that all pastors, perhaps your diaconate, but particularly the individual responsible for the payroll function in the church, should really review this publication. Because the tax treatment of clergy is somewhat an anomaly in the tax code. Clergy are common law employees subject to the same rules governing employer-employee relationships, but for tax purposes, they're treated as self-employed. And as such, on their tax returns, they are to pay a 15% self-employment tax on their ministerial earnings. Now, self-employment tax represents Social Security and Medicare taxes, but rather than having those taxes withheld from their pay and the employer sending in a matching contribution, The pastors are supposed to report both of those portions, as it were, on their tax return under this self-employment tax. This differentiation is also further confused by the fact that pastor compensation should be reported on a W-2, not on a 1099. So again, there's where we have some different practices out there. If you were to review Publication 517, it includes a comprehensive example illustrating the proper reporting of these amounts. So again, I can't recommend it highly enough that that publication be downloaded from the IRS website and reviewed. The reporting requirements are a little confusing, but they're not difficult. And the comprehensive example is very helpful in that regard. Perhaps this topic is suitable for another webinar, and maybe we will do that, but just keep in mind that this is how the IRS is asking for it to be reported. And pastors need to make sure that they have sufficient taxes either withheld, income tax withholding on their pay, or by paying quarterly estimates. And the same is true for any state income taxes as well. Now, just to further assist, just a review here of what is taxable compensation for clergy. Compensation for income tax includes the base cash salary. It includes any love offerings collected from the congregation. That may be at Christmas time, birthdays, anniversaries. It includes any FICA tax reimbursements that the church may pay to the pastor. So with the pastor paying this self-employment tax, he's paying what might otherwise have been the employer's matching contribution. So many churches will reimburse that. That's actually a taxable reimbursement. And then also taxable is any health reimbursements that are in excess of those prior HRA limits that we talked about earlier. What's not included in compensation for income tax purposes is the housing allowance or the fair value of the parsonage provided. Do not include pension contributions and do not include accountable expense reimbursements. Now, when it comes to that self-employment tax, we do have to add back the housing allowance because that is subject to self-employment tax. The income tax compensation typically is reported on the W-2 in box 1 only, and maybe in the state wage box. The housing allowance should be noted on box 14 on the W-2. Again, just a little helpful hint for you. One of the common questions I get asked from pastors is whether or not they should claim exemption from the self-employment tax. The application can be made using IRS Form 4361. The form is pretty straightforward, but it is a certification of the pastor's conscientious objection to public insurance, like Social Security and Medicare. And then once it is approved by the IRS, it does exempt any ministerial earnings from this self-employment tax. Without discussing the conscientious objection aspect of the application, my advice to pastors regarding this has been twofold. First, keep in mind that if you are exempt from Social Security and Medicare, and so if you file this exemption and you have not earned enough credits in the system prior to obtaining the exemption, you will not qualify for free Part A Medicare coverage. So you would have to pay for that if you wanted it. So that's just one thing to keep in mind. But probably more important is, while not having to pay the self-employment tax can be a great savings, if you're not taking equivalent funds or reasonably equivalent funds of that tax and investing them in some kind of retirement plan, in my humble opinion, you could be potentially creating a future diaconal need. So it's something that you need to prayerfully consider, carefully plan, and faithfully execute on that. Now, I do want to give you a quick update on the housing allowance. Certainly, the housing allowance from an income tax perspective is a distinct advantage that pastors have, because while the housing allowance is exempt from tax, pastors can still deduct mortgage interest paid and property taxes paid. So it's one of the few instances in the tax code where a double dip is permitted. But there has been a recent challenge to the housing allowance. In 2013, there was a court case filed by an atheist group in Wisconsin arguing that the housing allowance was unconstitutional. The judge in that case ruled in their favor, but on appeal in the Seventh Circuit, it was overturned for lack of standing. That is, the group couldn't prove they were sufficiently injured. So the same group, went back, filed tax returns, falsely claiming a housing allowance for their leaders, which was then rejected by the IRS. With that in hand, they filed suit again before the same Wisconsin judge. They received a ruling declaring the housing allowance unconstitutional. And as of this time, we are awaiting ruling from the Seventh Circuit on the appeal. In fact, next Wednesday, oral arguments are set to begin on this case. So keep that in mind. If the court overturns the decision again, the housing allowance remains tax-free. But if the court upholds the decision of the lower court, then the housing allowance becomes taxable for taxpayers in Wisconsin, Illinois, and Indiana. What will the IRS do? We don't know. The IRS has the option to try and make it taxable nationwide, or they could simply not adhere to the Seventh Circuit's decision. We don't know what they're going to do, and so it's very uncertain. As far as the case appealing all the way to the Supreme Court, probably not likely at this time that the Supreme Court would hear it. They really only hear very few cases brought to them. So it all may depend on the IRS's reaction based on the Seventh Circuit's opinion. So it's important to keep an eye on this as the situation develops. So while the Tax Reform Act in many ways is an initial step to a perhaps more simplified tax code, those changes have introduced some complexities that need to be reviewed. So many things that we do have tax consequence. Things like changing jobs, having children, planning for retirement, perhaps buying a home, or anytime you receive a raise, or opting in or out of a retirement plan like a 403B. So hopefully I've touched on some relevant topics. But again, with these new laws, changes to your particular situation, it's always a good idea to review this with your tax preparer as well. On a final note, here's some helpful resources that you may want to take advantage of. Certainly, we have the IRS website. Here's the link also to that IRS publication 517. And you may also want to review these other websites, the Church Law and Tax website. They also publish an annual tax guide for church and clergy, which is a very useful resource. I would encourage churches to buy that as well. And then, of course, there's the website for the Evangelical Council of Financial Accountability. They provide a lot of resources regarding best practices for churches and other charitable organizations. So with that, I think we can go to questions.
Thank you, Doug. I've been monitoring the questions throughout, and I've got a few for you. And everyone feel free, if more come to mind while Doug's answering these, to submit further questions. First question we have is, will the HRA be included in the W-4, or is it just as a reimbursable expense and not reported?
So if the reimbursement is within the allowable limits, so again, it's a little over $5,000 for single coverage, a little over $10,000 for family coverage. If the reimbursement is within those limits, it's not included on the W-2. But if you go over those limits, it's my understanding the excess is what's reported on the W-2 as part of taxable compensation.
Thanks, Doug. We also have a question: how does child tax credit work for a child who is turning 17 in December of 2018?
Okay, so for child turning 17 in December, correct. Yeah, it's all determined as of 12/31. So what is the status as of 12/31? So if the child turns 17 in December, then the per child tax credit, you will not receive it for that child. However, you would still receive the $500 credit in its place. So it's obviously not as good, but yeah, the status is determined as of 12/31.
Would you explain the difference between charitable annuity trusts and charitable remainder trusts?
Ooh. Charitable annuity trust, charitable remainder trust. For the most part, they basically function the same. The idea is that you put money into the trust, and then there's an actuarial determination made as far as, because what happens, you put money in the trust, then you receive back from the trust annual distributions based on an actuarial determination. And then when you pass away, whatever balance remains in the trust goes to the named charity. The difference between annuity trust and remainder trust, I think, primarily has to do with how those annual distributions are calculated.
Okay. How would a love offering be reported? Would it just be added to the W-2 under salary?
Yes, that's correct. So basically, it just gets added to total compensation, total taxable compensation, and then reported on the W-2.
We have someone asking, will your slides be available for download later? Is that something you'd be willing to
Yes, yes. What I will do, Mark, actually, I will forward the PowerPoint to you.
Okay, and we'll
and
upload
then
it onto
you
the
can
website.
make it available. Yep, exactly.
Thank you. That's all the questions I see. We do have a note here from Greg DeYoung, who's a member of Committee on Ministerial Care. He wanted to make note for church treasurers that contributing directly from an IRA to church or charity through a qualified charitable deduction is only available if you have reached age 70 and a half. Church treasurers should consider making sure that congregants are aware of this powerful tax-saving strategy.
Yes, that is correct.
Those are all the questions that I see of coming in. One question I had for you, Doug, with the Tax Cuts and Jobs Act, I've seen rumored the possibility that nonprofits with parking space where they allow employees to use that parking space, that space may come under taxable.
Yes,
it may
that
be
is
taxable itself. Is that correct?
that is correct. And as I recall, because I was recently looking at this for another congregation, it has to do with parking facilities that the church actually pays for. So if you're a church or an organization that happens to have a parking lot that's part of your property, and your employees park on it, that's fine. But if it's a facility you're paying for, or a facility you own and you charge others to park on, then it's a taxable situation for your employees if you permit them to park there at no charge.
Okay. One other question came in. Weren't love offerings non-taxable in the past?
No, this is one of those areas where there was some confusion, but no, it always was taxable. The idea, the theory behind it with the IRS is that you're collecting money from the congregation, and it would be one thing if the individual congregants, made out a check to the pastor, put it in a Christmas card, and sent it to him. That's one thing. But when the congregation the church participates in the collection, the IRS reasoning is that you're doing that, you're collecting this because he is your employee. And whenever you have a situation like that, it becomes taxable. So, some churches have done that. They've sort of restructured it and just said, if you want to give a gift, go ahead and give them a gift. But if it's a situation where you do an intentionality, have a collection, it creates a taxable situation, unfortunately.
Okay, good to know. I think that's all the questions we have for the day. Thank you, Doug, for taking time to talk to us. It was very helpful. And thank you for your volunteering to be the first speaker for us.
Sure. Oh, you know what? There's one more question. What question is, if love offerings to pastors, are they deductible for the giver? So in those situations where it's through a congregational collection, yes, they are. But if you're individually writing a check and sending it to the pastor on your own, that's just a gift, and that's not deductible. But if it's done through the church, and you're writing a check out to the church and so on, then yes, it would be part of your deductible offerings.
Okay. Well, thank you to everyone who came and participated in this first webinar. We'll send out announcements with our next topic and when that will be. I hope that you have a good rest of your day, and we'll look forward to meeting again for our second webinar. Have a good afternoon, everyone.
Okay. Thank you.